You've done the math. Spent an evening, maybe several evenings, with a spreadsheet, a calculator, and that specific focused energy that comes when something finally feels within reach. You know your monthly expenses. You've multiplied by 12. You've applied the 4% rule. You have a number. Maybe it's $1.5 million, maybe $2 million, maybe 800,000 if you're planning to live simply. That number sits in your mind now like a destination. Every investment decision, every savings rate calculation, every career choice gets filtered through it. How much closer does this get me to the number? And the number feels scientific, rigorous, derived from actual research. The Trinity study, the 4% withdrawal rate, decades of market data. This isn't wishful thinking. This is math. Except, the math most people are doing is missing several variables that, when added, move the number significantly. Sometimes by hundreds of thousands of dollars, sometimes by more. And those missing variables aren't obscure edge cases. They're predictable, structural features of what financial independence actually costs to maintain over a 30, 40, or 50-year retirement horizon. Today, we're going to find every gap in the standard calculation, not to make the goal feel impossible, but because a number you reach that doesn't actually fund the life you planned is not financial independence. It's a different kind of trap. The 4% rule, what IT actually says. Before we find the gaps, let's be precise about what the 4% rule actually is, because most people are using a simplified version that omits important context. The 4% rule comes from the Trinity study. Published in 1998, researchers analyzed historical market data and concluded that a portfolio invested in a mix of stocks and bonds could sustain annual withdrawals of 4% of the initial portfolio value, adjusted for inflation each year across a 30-year retirement period, with a high historical success rate. That's the rule. And within its specific parameters, it holds reasonably well, but notice what the parameters actually are. 30 years, not 40, not 50. Not the 45-year retirement of someone who achieves financial independence at 45 and lives to 90. A specific portfolio allocation. Not 100% cash, not 100% stocks. A balanced mix that most people don't maintain with discipline through market downturns. Historical U.S. market data, which has been among the strongest long-term market performances in the world. Not a guarantee of future performance in any market. And a high success rate, not a perfect one. The Trinity study's 95% success rate means 1 in 20 historical scenarios ended in portfolio depletion before 30 years. Those aren't great odds when the scenario is running out of money in retirement. The 4% rule is a useful starting framework. It is not a guarantee, and the ways people apply it, to longer time horizons, different asset allocations, different market environments, introduce compounding error that can be significant. Gap 1. The sequence of returns risk you're not pricing in. Here's the first major variable most FIRE calculations ignore. You've accumulated your number, $2 million. You begin withdrawing for percent, $80,000 annually, adjusted for inflation. Whether that withdrawal rate succeeds depends enormously on what the market does in the first 5 to 10 years of your retirement, not the average return over 30 years. The sequence of those returns. If markets perform strongly in your early retirement years, your portfolio grows even as you withdraw. A later downturn is manageable because you still have significant capital working. If markets perform poorly in your early retirement years, if you retire in 2000 or 2007 or 2022, you're withdrawing from a shrinking portfolio. Each withdrawal represents a larger percentage of a smaller base. Recovery becomes mathematically harder because you have less capital remaining to benefit from the eventual rebound. Two people with identical portfolios, identical withdrawal rates. And identical average returns over 30 years can have dramatically different outcomes based solely on the order in which good and bad years arrive. This is sequence of returns risk. And the standard FIRE calculation, multiply expenses by 25, withdraw for percent, doesn't account for it. The practical implication: your number probably needs a buffer for this. Either a larger portfolio than the base calculation suggests, or a flexible withdrawal strategy that reduces spending in years following poor market performance, or a portion of assets in non-market instruments that provide stable withdrawal capacity regardless of market conditions. None of these adjustments are complicated, but none of them appear in the standard calculation. Gap 2. Healthcare, the expense that compounds differently. If you achieve financial independence before Medicare eligibility at 6 to 5, you face a decade or more of private health insurance costs that most FIRE calculations dramatically underestimate. This is not a minor line item. A healthy 40-year-old purchasing an ACA marketplace plan in most U.S. states is looking at premiums of $400 to $800 per month for individual coverage. Family coverage can run $1,200 to $2,000 monthly. And these premiums increase with age, often significantly, regardless of whether your income is stable. At 40, you might budget $6,000 annually for health insurance. By 55, the same level of coverage might cost $15,000 or more. By 64, just before Medicare eligibility, premiums for older adults without employer coverage can reach $20,000 annually or higher in many markets. And premiums are only part of the picture. Deductibles, copays, out-of-pocket maximums, dental, vision, long-term care insurance as you age. The total healthcare cost picture for a person managing their own coverage from 40 to 90 is substantially larger than what most people put in their FIRE number. The standard calculation takes current monthly expenses, multiplies by 12, multiplies by 25. If current monthly expenses include employer-subsidized health insurance, a few $100s per month in employee premium contribution, the calculation is anchored to a number that disappears the moment you leave employment. Healthcare alone can require adding $200,000 to $400,000 to your FIRE number, depending on your age at retirement and your anticipated coverage needs. This is not a rounding error. It's a structural gap in the standard methodology. Gap 3. Inflation isn't average, and some categories hit harder. The 4% rule adjusts withdrawals for inflation. Standard FIRE calculations typically use average inflation, historically around 3% annually, as the adjustment factor. The problem: your personal inflation rate is not average inflation. It's the inflation rate of the specific goods and services you consume. And some categories inflate significantly faster than the general average. Healthcare costs have historically inflated at 5 to 6% annually, nearly double the general rate. If healthcare represents a significant portion of your retirement budget, anchoring your inflation adjustment to average CPI understates your actual cost growth substantially. Higher education costs, if you have children whose education you plan to support, have inflated even faster. Housing costs in many markets have inflated faster than general CPI. Long-term care costs, increasingly relevant as life expectancies extend, have their own inflation trajectory. The compounding effect of getting this wrong is significant. A 3% annual adjustment on an expense that grows at 5% creates a gap that widens every year, over a 20-year horizon. The difference between 3% and 5% annual growth on a substantial expense line is not trivial. The honest adjustment is to model your specific expense categories with their own inflation assumptions rather than applying a single average rate to everything. Healthcare gets healthcare inflation. Housing gets housing inflation. Food and discretionary spending get general CPI. This complexity is annoying. It's also the difference between a number that funds your actual retirement and a number that funds an abstraction. Gap 4. The life you'll want isn't the life you're budgeting. Here's the gap that's hardest to quantify, but potentially the largest. Your FIRE number is based on your current expenses, or a projected version of them adjusted for no longer commuting, no longer buying work clothes, no longer paying for the various costs of employment. But the life you'll live in retirement is not your current life minus commuting costs. When you have unlimited time and no structured obligation to show up somewhere, what you spend money on changes. Sometimes it decreases, often it doesn't. Travel becomes more possible and more appealing. The trips you took 1 week per year become the trips you could take for months. Hobbies that were constrained by time become unconstrained. The woodworking hobby that cost $200 a month when you had 8 hours of free. Time per week costs more when you have 50. Social spending often increases in early retirement. The lunches, the dinners, the experiences with friends and family that work schedule compressed. They expand when time expands. Home costs often increase. When you're home more, you notice things that need fixing. You want the space to be more comfortable. The projects deferred during working years get addressed. Research on retirement spending patterns shows that early retirement years tend to be active and relatively expensive. Travel, experiences, pursuing deferred interests. Middle retirement years stabilize. Late retirement years can spike again with healthcare and care costs. The flat monthly expense number projected forward from your current spending pattern doesn't capture this curve. Budgeting for a static retirement life while planning for a dynamic one creates a gap that shows up exactly when you're least positioned to address it, after you've already left employment. Gap 5. The tax picture changes completely. Most people accumulate their FIRE nest egg in tax-advantaged accounts, traditional 401ks, traditional IRAs. The math on these accounts during accumulation is straightforward and favorable. Contributions reduce current taxable income. Growth is tax-deferred. The math on withdrawal is more complicated and often surprises people. Withdrawals from traditional retirement accounts are taxed as ordinary income. Every dollar you withdraw adds to your taxable income for that year, which means your 4% withdrawal is not 4% of your portfolio landing in your account. It's 4% of your portfolio, minus income taxes on that withdrawal, landing in your account. If you need $80,000 to live and you're pulling from a traditional 401k, you need to withdraw more than $80,000 to net $80,000 after taxes. How much more depends on your total income picture, your deductions, and your state tax situation. This gap between gross withdrawal needed and net income received is a systematic undercount in FIRE calculations that assume withdrawal rate equals spending capacity. There's also the required minimum distribution problem. Traditional retirement accounts require mandatory withdrawals beginning at 73. These RMDs are calculated based on account value and life expectancy tables. And in a scenario where you've accumulated a large portfolio and been withdrawing conservatively, the required distributions can be substantial and push you into higher tax brackets involuntarily. Managing the tax picture in retirement, Roth conversions during low-income years, strategic withdrawal sequencing, understanding the interaction between investment income and Social Security taxation is a discipline unto itself, and it affects how large your number actually needs to be to fund a given after-tax spending level. The real number. What changes when you add the gaps? Let's put this together concretely. Standard calculation. Spend $60,000 annually. Multiply by 25. FIRE number is $1.5 million. Now add the gaps. Healthcare premium differential. Current employer subsidized cost versus full private market cost over 25 years of pre-Medicare retirement. Add $150,000 to $250,000 to the number, or increase annual expense baseline by $6,000 to $10,000. Sequence of returns buffer. Most conservative FIRE practitioners suggest a 3.5% withdrawal rate rather than 4% to account for sequence risk. Same $60,000 annual spend now requires a portfolio of $1.7 million rather than $1.5 million. Retirement spending curve. Accounting for higher spending in early active years and potential long-term care costs in later years suggests budgeting at the higher end of your expense range rather than current average. Add another 5 to 10% to the baseline. Tax gross up. If pulling from traditional accounts, needing $70,000 gross to net $60,000 after tax changes the effective withdrawal rate calculation. The conservative, honest number for someone targeting $60,000 in annual retirement spending is closer to $2 million to $2.2 million than $1.5 million. Not impossible, but meaningfully different from the number the standard calculation produces. And for someone retiring at 45 rather than 65, extending the horizon to 45 years rather than 30, the 4% rule's historical success rate drops. Many researchers suggest 3 to 3.5% as a more appropriate withdrawal rate for very long retirements. Same $60,000 annual spend at 3.5% requires a portfolio of $1.7 million. At 3%, $1.7 to $2 million. Every adjustment is individually reasonable. Together they move the number by hundreds of thousands of dollars. What to do with this? None of this makes financial independence not worth pursuing. The goal is legitimate. The pursuit is meaningful. But pursuing a number that's too low doesn't produce financial independence. It produces a fragile version of it, one that survives only if markets cooperate. Healthcare costs behave, spending stays flat, and nothing unexpected happens across a 40-year horizon. What produces real financial independence is calculating the honest number, the one that includes healthcare. That accounts for sequence risk. That models your actual retirement life rather than a static projection of your current expenses. That accounts for taxes on withdrawal. And then building toward that number with the same rigor you brought to the initial calculation. The practical adjustments aren't complicated. Use a 3.5% withdrawal rate instead of 4%. Model healthcare costs separately and honestly. Build a 1 to 2 year cash buffer outside your invested portfolio to weather early sequence of returns risk without selling at market lows. Use Roth accounts where possible to reduce tax complexity and withdrawal. And revisit the number regularly, not obsessively. But the inputs change. Your anticipated retirement life clarifies as you get closer. Healthcare cost projections update tax law changes. A number calculated at 30 with rough estimates needs recalibration at 40 with better information. Closing. The number feels like an answer. It gives a destination to what could otherwise feel like an endless accumulation without clear purpose. It makes the goal concrete. It converts abstract wealth into something measurable. That function is genuinely valuable. The goal of financial independence, accumulating enough that work becomes optional, that you own your time, that financial stress no longer governs your decisions, is one of the most meaningful financial goals a person can pursue. But a number calculated on incomplete inputs isn't a destination. It's a mirage that looks like a destination. The 4% rule is not wrong. It's incomplete in specific, predictable ways when applied to early retirement over long-time horizons without accounting for healthcare costs, sequence risk, tax complexity, and realistic spending patterns. The people who achieve real financial independence, who reach a number and find that it actually works, aren't the ones who calculated fastest. They're the ones who calculated most honestly. Who asked not just what number do I need to stop working, but what number actually funds the life I'm planning. Across the range of scenarios that could reasonably occur, over a horizon long enough that getting it wrong has serious consequences. That calculation is less exciting than the standard one. The number it produces is higher. The timeline is longer. But it's the number that actually works. And arriving at a number that actually works, that funds real freedom rather than a fragile version of it, is the point, not the calculation. The freedom, get the number right, and the freedom follows. Get it wrong, and you discover the error at the worst possible time, when you're already there.